for everybody who's been asking us questions, or can you find us on Instagram? You can find us on Instagram. Leon, where would they find us?
It's the same thing. It's under Investing Education Academy on Instagram and YouTube.
Okay. So those are two ways you guys can find us. In addition, LinkedIn, we set up a group, but we're mainly funneling everybody to our group on Facebook. You can find us at Investing Education Academy on Facebook. So what's been happening over the last 3 weeks? Let me give you guys a quick rundown. Leon, if I have any gaps, please fill in the gaps. You all have been awesome. So if you have questions and if you can share this video, now would be a great time to share it. But up until this point, we've been doing this for 3 weeks at this. Today is like roughly 3-week anniversary. We are over a collective of 4,000 plus views. That's amazing. So we have to think that either we're answering you all's questions or this information is just something you really want to hear. To give perspective, because numbers in isolation really don't mean anything. For Bold Vision Enterprise, which is one of my companies, last year our goal was to get to 60,000 views. It took us a year to do that. At this rate, we'll do that like in less than half a year if we continue on this acceleration. So for everybody watching, thank you. Continue to share it. A couple stats that I'll share with you all. We've had people call us asking us if we would invest $100,000 for them, $60,000 for them, $1,300 for them, $50 a month. All of it is important because it all shows that you all like what you're hearing and you are beginning to trust us. But let me also say this, we are not going to do that. So we're not taking this. The goal of this really was to get a lot of the information and knowledge out of Leon and I's head, because we've been investing since, again, we were 15. But it wasn't to become a brokerage house. As the design of it was just information dissemination. We wanted to share with you all. Now we are creating the Investing Education Academy, where it will be a membership-based platform where you can go to it and get the videos we're putting out. We go deeper than what we do on these lives in that framework, and it's literally been built out right now. We think May 1st will be ready to go. We already have 23 people who are on the waiting list to join once the membership comes live, and we haven't even disclosed what it's going to cost. So that's pretty amazing that you all are believing us and want the information that much. You're willing to get on a waiting list and just see what it is. We really had the communities kind of start to come together in regards to Instagram, LinkedIn, Facebook, and YouTube. It's now one of those situations where people can't catch us on these Facebook Lives. They're going to check us out on YouTube. And then when they can't see us on YouTube, some people are watching us on LinkedIn platform, and we're getting a lot of shares in direct engagement on the Instagram platform. So Leon, I know you feel most of the Instagram engagements. How's that been going?
Good. We were up about 10 followers in the last week. We're averaging just under 10 per week. We're about every 10 days. So it's going good. The information is getting out there. People are liking it, and they're following.
Yep. And so for anybody that has a question right now, we're going to be talking about stocks that you can buy under $10. Let me tell you why we're talking about that. Because one of the people who recently joined the Investing Education Academy, Jamia, she asked us to talk about it. And so we're talking about it. And a lot of you all who have questions and maybe think they're not really going to talk about what I send in, we will. Not only that, Jamia, myself, and Leon have all been in conversations inside of the Facebook group, just talking about stocks in general. We welcome all of you all to, also come to the Investing Education Academy's Facebook page, because that's where we go. It's like this, from a tier standpoint, we do the lives and we keep the information here. You're going to benefit from hearing these lives. But then we go deeper where we actually say, okay, inside of our Facebook group, we're going to talk a little bit more, have an expansive conversation about a particular subject matter. And then in the membership platform is where we're just dissecting it. We're looking at every aspect and what it means to you as an investor. So, just continue to engage us. We absolutely will address any concerns that you have. And if you want to know something in particular, if you're watching this on any of the platforms right now, please, in the comment section, let us know what's most important to you about the stock market. If you all are watching this now, share it with your friends, groups, because we want to know, what is it that you want to learn about the stock market? What do you want to know about the stock market? What could we help demystify for you? Because that's our goal, to demystify the whole aspect of investing. I see you all sharing it now. So Mark, Mark Wiseman, thank you.
Mark Wiseman. Oh my, blast in the past, boy. Okay.
That's the shit from New York, coming straight out of New York. So Mark, we definitely appreciate. Actually, just glad to see your name pop up.
Mark Wiseman. Wow.
Yeah.
Okay. Yeah.
So, all right. Now we talked about that. Now we're going to dive into, really, why do people want to invest in stocks that are under $10? So before we start, this is just Leon and I's opinion. This doesn't mean that you all should invest the way we think you should invest, nor does it mean that the stocks that we pick at the end of this, which we pick 2 stocks every week that we will let everybody know about at the end. It's not for everybody. So please do your research. This is not intended to say it's an absolute guarantee slam dunk. That's not the way the market works. That's not how our advice is intended to be received. So you want to dive in, Leon? You want me to dive in?
I'll start. So my thing with stocks, I guess cheap stocks and inexpensive stocks, is people often think that, we all know it, everyone's looking for the home run, right? Everyone's looking for that lottery ticket. And everyone looks at a $10 stock and says, okay, in my mind, because I'm buying this, it's going to jump from $10 to $100 and I'm going to be rich. And the probabilities that are happening are almost zero. $10 stocks do not go from 10 to 100 overnight. I mean, they don't even do it over a few years. It takes multiple years for that to happen, if it happens at all. Everything is about percentages. And so I get, people look at cheap stocks and they're thinking, okay, it's going to be this home run. The problem with that is people don't also look at the risk side of the stock. Everyone thinks about their profits on a $10 stock. They don't necessarily think the risk. And I'm gonna kind of run through 2 scenarios today that show you the risk of a quote unquote cheap stock relative to the risk of a more expensive stock. So my example is, so say we have a $10 stock, right? And let's say on average, it moves 50 cents a day, right? No big deal. You're buying a $10 stock, 50 cents a day, no big deal. Let's say invest $1,000 into the stock. So you have 100 shares of a $10 stock, right? And it moves roughly 50 cents a day. No big deal, right? So let's say the first day you buy it, okay, the next day after you buy it, it goes down 50 cents. No big deal, it's only 50 cents. Let's say the next day it goes down another 50 cents. For whatever reason, the market is dropping and it's gone down 50 cents. So in a day, it's gone down $1. Now you may think that, that's no big deal. It's only $1, it's only 50 cents per day, no big deal. But actually that is a big deal. And the reason why is 50 cents on a $10 stock is 5% of the price that you paid, right? So in 2 days, so the first day it dropped, you lost 5%. Second day, you lost another 5% for a total of 10% on your money in 2 days, right? Now, to give some perspective, the market typically moves 10% in a year, right? So it'll go up 10%, maybe go down 10% in a year, 365 days. You just lost 10% in 2 days. And the reason being is that you thought because you were buying this cheap stock, it's not really that risky. It's not that dangerous. It only moves 50 cents a day, no big deal. But you got to look a little deeper. And the term for this is called volatility. And that's just a fancy word that says, what is a typical range of stock moves per day, per week, per month, per year? And we're looking at the daily volatility. And so the stock moves roughly 5% a day. And in that first 2 days you owned it, you lost 10% on what you thought was a safe, cheap $10 stock. You lost $100 on your $1,000. You lost 10% in 2 days. Now I'm gonna contrast that with a $200 stock, right? So let's say a $200 stock that roughly moves, let's say it moves roughly $3 a day, right? So the range will go up and down roughly $3 a day. So let's say you buy it. For the day after you buy it, it drops $3. Okay, no big deal. $200 stock. Next day it drops another $3. Okay, now you're down $6. Whereas before, remember, you were down only $1. Now you're down $6. Sounds a lot worse, right? It's really not, because that $3 move is only 1.5% of that $200 stock, right? So after 2 days, you've lost 1.5 one day, 1.5 the second day. So you've lost a total of 3% on a $200 stock. Now contrast that with a $10 stock, where in 2 days you lost 10%. So that's the danger that can come with buying, with really targeting cheap stocks, is their daily moves on a percentage basis can be a lot higher than their daily moves on a more expensive stock. It kind of comes back to the point Brent made a few weeks ago when he bought, I think it was Amazon for $500. And people are like, well, why the hell would you buy Amazon for $500? That's so expensive. Well, it is and it isn't. On a percentage basis, the move of that stock won't be as dramatic as something that Brent bought that was $5. So I say all that to say, the example was to bring across the point that cheap stocks are not always safer. You're looking at it as, I'm only buying a cheap stock. I'm only buying $10 stock. I can't lose that much. Well, you put $1,000 into that stock. That $1,000 is at risk, just like it is on the $200 stock. The problem is the daily moves of that stock are a much higher percentage on the $10 stock than they are on the $200 stock. So the risk is actually higher on this $10 stock versus the $200 stock. So I just want to make that point that when people ask about cheap stocks, a lot of times they're only thinking about, going from $10 to $100 and how much they can make. You really got to step back and look at your risk. And your risk on a daily basis is the average range of the volatility of that stock per day. So something you want to look at when you're looking at cheap stocks is knowing your risk for that stock, and also on expensive stocks, knowing your risk as well. But what that contrast showed you is that people fear expensive stocks because they feel like they're not going to make as much money. But you also got to look at your risk. The risk on an expensive stock typically is going to be less than the risk on a cheap stock.
Yeah, and also, when you look about it, you got to think about recovery capital. Like if a stock is trading at $10, the more likely the corporation behind it doesn't have large pockets for recovery money. So if that stock starts to slip and all of a sudden it is losing its footing, it doesn't have the capital just to dig into reserves and say, you know what, we're going to throw some money in research and development and fix it. Because the R&D money is not that deep. And so when you have a Google or some of these bigger companies, yeah, they start to lose market share, but easily they can go to R&D and say, let's increase R&D, let's increase marketing, let's reevaluate management. So we'll come back with a stronger, more agile product. Whereas those some of these smaller companies, when they have a person in place, and I'm using that word on purpose, a person in place who's running that company, we know what happened to Apple when Steve Jobs left. Now think about what happens to a company that's trading it. Well, actually, they were trading about 10 at the time. So that's a good example. So they almost crashed. The question was, will they survive? Until iPhone and iPod, he came back to the company and brought the iPhone and iPod back to them for the first time around. And the market started to really understand that he was ahead of the technology curve and that this assumed would be adopted by the marketplace, and it blossomed. But that company almost lost everything because he left. And he had to come back to save it because at that time they were a $10 company. So it actually is a great example of that. So, you look at
another point I just want to make on kind of on that on the institution side. So another thing about cheap stocks. So the market is moved more or less by institutions like banks, hedge funds, big companies like that. Not us. So, we try to ride the coattails of the big companies. A lot of big firms, they actually want to invest in companies that are $10 or less or $5 or less. Reason being is that it's something called liquidity, and it's the amount of shares traded per day and the amount of money rolling in and out of that stock per day that is often a lot less in cheap stocks than in high value stocks. So what will happen is a lot of times when you get in, the moves are a lot more dramatic. Like I said, that 50-cent move. Remember, that's a 5% move of a $10 stock. That's a big move. That's a really big move. And the reason that is a lot of times you have smaller players in there, almost like day trading it and really shifting the price around a lot. And you don't have those big boys like the hedge funds and the banks in there to stabilize those price shifts like you do on expensive stocks. So another issue with cheap stocks is that liquidity is often a lot less than a higher price stocks. And by liquidity, I just mean the amount of trading that goes on by big firms. And we're not saying all this to scare people away from $10 stocks or stocks under $10. There's nothing wrong with it. It's all about when you go and know your risk. Know your risk before you get in.
And to us, volatility might be our risk. To an institutional investor with a $10 stock, liquidity risk becomes an issue. And so, credit risk is another issue to the actual company itself because it's harder for smaller companies to get credit to grow. Now, when you look at why you're investing, now let's talk about the good side of a stock that's $10 or less. When you do get in on an Apple when it was at $10 and it was in dismay, or even Bank of America at one point was trading below its actual book value. It was trading about $5 a share. The book value was like $7. When you have these stocks, these $10 or less stocks, there is an opportunity to grow, especially when that is an abnormality in their trading cycle. So if it's normally, $50 a share, where we're seeing a lot of stocks right now, the market overall is, I think it's like $7.2 trillion has come in value, has been reduced in the marketplace over the last 4 weeks. Now, respectively, when you are investing, you should know you don't really have a realized gain or loss until you actually sell the stock. So a lot of you people who watching this, I've heard the stories. I've been a storyteller myself. Oh man, I made $500 today, and
Yeah.
I didn't liquidate the stock. So I have the potential for a $500 profit if I pull it out. I haven't made it yet. That's probably a course we could teach, but just so you all know, because on the other side of that is the people who get very depressed or down, and they're like, oh man, I lost 500 today. And for you all, I'm also saying you haven't really lost it. It's just the fact that it's unrealized at this point, because the market still has the ability to have that volatility Leon spoke about, and that goes ups and down, those swings. So when you look at a stock that is $10 less, theoretically, the thought is it has the potential to become a $5,000 a share stock. The probability of that happening is really low.
Damn near zero.
Yeah, it's like really thinking you're going to get into the NBA because you practice once a week.
Right.
No. Now, you do see those people in the NBA who made it, which you do see the Amazons, the Netflix, and you're like, oh my God, I remember when Netflix was $11 a share.
I remember Google was $85 a share.
Yeah, but the reality, I remember when Google did their offering, because they were the first company to do a Dutch offering.
Yeah, yep.
Anyway, so when you see these anomalies happen in the marketplace, it's similar to when people want to really get into IPOs, because they feel like if I get into an IPO, I'm guaranteed to have this amazing return because I was in on an IPO. Number one, it's highly unlikely that you're going to get in on an IPO because that's money reserved for institutional investors, bigger companies like Leon talked about. But then two, even if you do get in, you're getting in after everybody internally has acquired their shares, and more than likely they're about to dump it, because as soon as it went public and they got it for 55 cents a share, now it goes public at 12, they're out. There's over 1,000% increase in their money. Right. And now you're left holding the flag or the bad side of the stick, because everybody got out because they make their money. So just know there is potential in $10 or under stocks to appreciate. There are great stocks to buy that are $10 or under. Just don't think that it's the glass slipper that you just found at the ball.
Right.
It's not. And also, this goes back to emotions. When you start playing the $10 and under game, and for anybody watching this, some of you all have asked us the questions offline, what is a penny stock? A penny stock is any stock traded under $5 a share. So a $10 stock is technically not a penny stock. And even when we use the words cheap or expensive, it's really relative to what you consider to be expensive or cheap.
Right.
Because I thought Google was cheap at $500 a share.
Right. Yep.
My sister standing next to me was like, "You're an idiot. It's $500 a share. Like, that's too expensive." But for what I saw as their potential growth, it was cheap. Right. And so when you all are thinking about what's cheap or expensive, don't get too hung up on the words, but think about what it means relative to your budget. And Leon always says this, I'm going to cue it up for you. Only invest money that is
risk capital. Risk capital is defined as capital that you can lose. Money that you're not buying groceries with, you're not feeding your family with, you're not your child's college fund. It's money that if you lost tomorrow, you wouldn't even miss it. And especially on lower price stocks. And as I showed before, they can be a lot more risky, because again, that daily move is a higher percentage of the actual stock price. So when you're going for stocks that are less than $10, you probably want to lessen it. If you have $1,000 invest, maybe only put half, maybe a third into the stock under $10. Versus if you're going to do a $200 stock, just because again, that risk, that up and down move can be a higher percentage than on like a $10 stock versus a $200 stock.
Yeah, and Leon and I are living this. We told you all that we were going to, when we open our brokerage account for Investing Education Academy, we're going to show you the moves. We're going to talk to you on a monthly basis about what we're investing in, why we're investing in it, why we pulled out of something, why we're going long, why we're going short, whatever it might be. We're going to real time discuss our brokerage account with you all, everyone who becomes a member of Investing Education Academy. But just to share with everybody, and Leon, we can just give them a high level, or we can go as deep as you want to. I'll start it, and you can take it where you want it to go. Recently, we were talking about, like, what is it that we're trying to do? Like, Investing Education Academy, what should it be doing for everybody who's watching like right now? Our experiences should lower the curve of you all becoming successful investors. That's the best way I can describe it. Our experiences and knowledge should lower the curve of you all becoming better investors. And for you all who are already investing, we should serve as like a sounding board to say, you know, I've been thinking about these things, or I've been doing this so long, it's been successful, and just sharing best practices. So it's not just for beginners, it's people who are experienced investors as well, because we get to share best practices. And from what we've been hearing in the Facebook group, people really just want to know what other people are doing. And Leon and I are part of other investment groups, and the information sharing is so rich in these environments. Is the only reason for you all to join Investing Education Academy isn't solely, oh, I just want to hear what Brent and Leon have to say. That's as far away from the truth as possible. We want to provide the environment of people who understand investing and who want to share, so we can just start having that conversation, because we just learned about an opportunity that we invested in where we became part owners in a startup company. And they did a STO, which you want to tell me what STO is, Leon?
Yeah, so an STO is a secured token offering. So basically what we did is, so we it's funny, Brent and I kind of came together, not meetings, we were kind of just having a discussion. We realized we had both read about this particular company. It's called Popcom, Popcom. And they make technology for like kiosk retail. They're a startup. And they previously have raised over $1 million in venture capital, and they want to do another round. It's actually founded by I forget her name, but she's the first African American woman and/or African American period to do a secure token offering and raise the maximum amount, which was over $1 million. So the secure token offering, all it is instead of issuing actual shares, you're actually buying a coin that then owns a particular percentage of the company. So Brent and I put up some money, and we're now an investor in this company, partly because we think the technology is great, but also we're kind of curious on what is the whole fundraising thing about, right? Like what happens behind the snees? Because like I said, we're very schooled in the stock market, but you know, we know our limitations, and we're not very schooled on kind of the venture side and kind of the private equity side. So we again put our money where our mouth is, and we'll actually at some point we'll show you we'll actually publish the correspondence we got from them showing the shares we got. But we're interested in learning ourselves on how does the private side of funding and investing work. And that's something we eventually want to bring to Investing Education Academy is also private equity, investing in private companies before they go public. So that's why we're kind of doing this, to kind of educate ourselves on the private side of investing and not just the public markets.
Yeah, and her name is Dawn Dickens.
Right.
Dawn Dickinson. And so, you know, as we take this journey, even with the private or as the STO, participating in the STO.
STO.
Secure token offering.
Yeah.
What did I say?
I said SCO.
I probably said SEO on accident. But secure token offering, the STO, we're going to bring you all on that journey with us. So we're going to be, you know, as we get investor or ownership updates, we're going to talk to you about what it is, how we received it, what does it mean. So when you all start to see a STO, which many of you probably have never heard that term until this live, and I'm sure people are Googling it like right now. Now you get to, if somebody comes out with an offering, you can say, you know what, I know what that is, and it's not scary anymore. Mm-hmm. It's not this ambiguous thing I've never heard of. Like, no, I'm part of IAA. Like I heard that before. They talked about it. Mm-hmm. And, you know, we would love to at some point get Dawn Dickinson on to really talk to you all about why she did the company that way and what it means for investors. Now, going on journeys like this, or going on journeys through our money, is leverage for you all to say, you know what, I saw where they messed up, because this company could burn and crash.
Right, we could lose it all. I mean,
yeah, because it is a penny stock. This is a penny stock. We got it at 55 cents a share.
Right.
And so, you know, now you think about that, all these things we just said, we're exposed to it. But as being exposed to every risk factor that we just mentioned, we also have that ability to kind of share the story. And if you have questions about what an STO is or what it does, or what does it feel like? And that's important. You all have to start asking that question. What does it feel like to be invested in it? Like when you all think about what you want to buy or what you maybe want to sell, think about the emotion that's going to be connected to the buy or sell, because I'm telling you, and I'm going to say this a million times as you become a part of IAA's framework, you need to understand your mental state and your emotional state when you are playing the stock market. And it really is a place that you play, and you should be using money that's not like live or die money. Now, Leon, this is the first time you're going to hear me say this, but I actually would love to do a webinar where we talk about different funding sources for people purchasing stock. And
right.
the reason,
yeah,
the reason why I would like to, well, not even with the STO, but I've had a number of people ask, like, should I take out an equity line of credit? Or
traditional, right? Okay.
Like, should I have a savings account versus this account? But on that, and the reason why I don't want to do it is Facebook Live, I would want people to register and then also have that direct engagement. Like if it's just 10 people, it's 10 people we go all in with. If it's 20 people, then it's 20 people. If it's 100, then we cut it off. We should cut it off at a certain point.
Right.
But right now, there are a lot of very creative funding strategies that people can really put in place to maximize their stock investing, where it necessarily wouldn't be discretionary funds. But anyway, there's a lot of ways to invest in the market and to get creative with your financing for your own investments.
And kind of on the point is like you said, external funding, crowdsource funding. So an STO is a form of crowdsource funding because it brings together unaccredited investors and allows them to invest in private equity or private stock. So these are opportunities. I mean, before I did this, I've never been in crowdfunding. I've never done a crowdfunding, much less an STO, which is relatively new. But crowdfunding is another investment opportunity for all of us. And I don't know if any of you have tried it. This is Brent and I's first time trying it. Like I said, we're going to share our experience as we go through this. But crowdfunding is kind of an umbrella term. Then there are a bunch of different ways to fund to get to join investments underneath crowdfunding. And STO, which we engage in, is one of them.
We should do one on different investing options, because the one I'm talking about is going to be on funding, like to fund the investments.
Right.
This would be on the actual investments themselves, because you do have crowdfunding, and you have a lot of different ways to do crowdfunding, and then you have people to do Dutch offerings.
But see, the difference is it's kind of one and the same, because one is a funding source, but one is also an investing source. So if it's say we're a company and we want to go out and get funding from say an STO or whatever, it's also an investment opportunity for people on the other side that are investing. So it kind of plays both sides. Yeah, we can when we do one on funding, it can also at the same time be on investing, because there's
financing. I should change my words. I mean how you finance your investments.
Oh, God. Oh, okay, that's different.
Like, so are you going to use savings account money? Are you going to use?
Yeah.
Because it's some people I've heard even talk about pulling money out of credit cards and cash advances. I mean, I've heard it all. And so another group, some things I've heard is about people taking crypto, cashing it out, and then using converting the crypto to the major 3, and then using that converted cash to actually go back into it's a lot of things that people.
A lot of ways, yeah.
The financing of their investments. So,
gotcha.
So the funding of it would be how the companies get funded. I'm talking more like how people get their money into the company.
Then fund it, yeah, right, gotcha. Okay.
And I think those should be separate, because one is going to require people to have time to actually get their money together, like, okay, and even know what their accounts are, because a lot of this is going to boil back down to really bookkeeping and how people budget. They keep their budget. So that'll be good.
So, I mean, that's something we can talk about.
Yeah, and I would love. You guys just got to hear us brainstorming. This is what we like. The reason why we started IAA is because we have conversations like this all the time. We would love to hear from you all. Like, if you could send us direct messages on what would you like to know about the market, what type of funding or financing or investment types would you like to know more about? If you have, really questions just individually, we prefer that you drop the individual questions into the Facebook group, and Investing Education Academy is our Facebook group, just because more than likely, if you have that question, somebody else has the same question sometimes they didn't even know they had.
Mm-hmm.
And so when they hear you ask it, they're like, oh, yeah, I need to know the same thing. And
Right.
so,
It's learn from shared experience and shared knowledge. Yeah.
mm-hmm. And so with that being said, you know, Leon, if you have anything in closing you want to say, we can jump to our 2 stock picks.
So yeah, so just kind of reiterate what I said before is that with stocks under $10, just know your risk. Just go in knowing your risk. And as I said, the best way to know is to find out what that daily, typical daily range a stock moves in, to know your risk. The example I gave, again, $10 stock moves roughly 50 cents a day. Doesn't sound like a lot, but actually that's 5% of the stock price. So you have a potential per day, you can literally lose 5% of your money per day. If it, if say it dropped 5 days in a row, you're down 25% in a week. So just know your risk going in on cheap stocks.
Yeah. And again, for everybody who's watching, this is the drum roll part where you want to know what are our stock picks for this week. So it is 4/22/2020. And for me, it is Halliburton. So I picked Halliburton because of what's happening with oil right now. Halliburton is taking roughly like a 257% drop in share price. That share price drop means that even if they recapture only 100% of where they used to be, that's going to be 100% increase in the stock price for you all. So right now their range, I mean, they're right around like $7.50 to $9 a share as of this date, and that's why I actually said the date. And we should probably start saying the date on these because it makes people understand the stock pick. So yeah. So, really 4/22/2020, Halliburton's trading between $7.50 and $9 a share, which means it's under $10. It normally is trading about $31 a share. My thought again is if they can just get back to 17, 19, that's probably when I would think about an exit strategy, but that's a whole nother conversation. If they do get to that place, that means you will have, if you purchase relatively soon, you will see about 100% increase in stock price. I don't know how long it'll take them to get back to even 100% of where they used to be, or get back to 50% where they used to be, which would be 100% move in the stock price right now. Because what's happening with oil is it's taking a huge beating. But in that market, Halliburton provides services to most oil discovery companies. So they're doing the concrete work. They're providing the very specialized tools they use for extraction. They're doing fracking. They're doing a lot of things that provide supplies to these various oil companies, which makes them kind of the epicenter for needs for many. They're not the only, and that's where it can get dangerous, because right now the world is shifting. China's really moving into the oil space heavy. And so American companies like Halliburton, what will happen in, 5-10 years? I don't see them being a risk just because of the market capital size of the company. But at the same time, it's a great buy for me, considering I don't want to go extremely risky, but the market is extremely depressed.
All right. And just real quick on that point, I don't know how many of you follow the oil market, but 2 days ago, oil dropped below zero. And oil closed at a negative $32, right? And like people I was talking to were saying, well, why isn't the gas station, damn near zero? It was I believe it's the first time it's ever happened that oil actually dropped below zero. I'm gonna put up a post later today that explained what happened behind the oil dropping below zero, but it's never happened before. It's crazy.
Let them know what it's supposed to be.
Oh, so the post to be on Instagram and on Facebook, both of our main platforms. So I'll post that later today. But it's really fascinating to see oil literally go negative and close at negative $32.
But it's only in this space. Don't forget, it's a reset. So it's
yeah. It's oil right now is not trading below zero. And the reason why it happened, but it was historic. It's never happened before, I believe. And again, I'll post later on why it actually happened. So interesting that you picked the oil company. So my pick is Regions Bank, ticker symbol RF. Give you some information on them. So they're part of the S&P 500, which means they're one of the 500 largest companies in the U.S. It's the 32nd largest bank in the U.S., which relatively stable. In 2019, it had 6.75 billion in revenue. From that, it had 1.5 billion in profits, which breaks down to about a 22% profit margin. And as we always say, numbers in isolation don't mean much. So that 22% profit margin. So JP Morgan is the largest bank in the U.S. And their profit margin is 31%. So Regions at 22% is pretty close to JP Morgan's, which gives you an idea that they're a very profitable company. And here's the kicker though, they pay right now they're paying a 7% dividend yield. And if that's kind of jargon to people, all that really means is that they basically pay an annual interest rate of 7%, right? So think of it like a bank. Think of it like your bank. In your bank right now, you're getting 0.0001% interest on your money, basically nothing. If you put your money in Regions, if the stock goes up, down, or sideways, you're still going to get your 7% a year regardless. Now, the only way that doesn't happen is if they cut their dividend, which is possible. That's a risk. But if it doesn't happen, you'll net 7% on your money every year if you were to buy it at the range it's at now. So dividend yield just means the interest rate that the stock pays per year.
Yeah. And real quick, let me just touch base on that. That everybody watching this should know, with the interest rates being in flux the way they are, it does affect the dividend yields by these bigger companies. It doesn't move much, but you will see dividends fluctuate. So if you get in now and you're like, oh, they said it was 7, but come August, they're saying it's 6 or 9. Just know that it does fluctuate. It's not fixed like some banking instruments.
Well, it's fixed. It's fixed relative to when you get in,
yes.
But it's not fixed long term. So in other words, if you bought Regions today, you would get a 7% yield as long as you're in that stock. Tomorrow, as the stock price moves, that yield can change. So the yield is based upon the stock price. But if you it's like a rate lock on a mortgage. If you buy Regions today, you're locking in 7%. If you then come in tomorrow and let's say the stock dropped, that dividend yield will actually increase. So tomorrow you may get 7.5%. But if you buy today, you're going to lock in 7%. But that rate does change outside of your investment as stock price moves.
And it changes on a annual basis normally. So
we're talking right. This is annually.
Yeah. So just when you say locked in, I just don't want people to think, oh, for life. Like it's called an ex-dividend date. And so if you are in before the ex-dividend date, which is important to know, that's when it gets locked in. Because sometimes they'll announce a dividend increase, and you might do this as a new investor, and you rush to like the market. They're not releasing that information until it's after the ex-dividend date in most cases. So all the loyal investors are already locked in, and now they're going to go release the information to the general population. And then sometimes people rush and think they're getting that rate, but then they get in and it's a different rate. So that means you were not in by the ex-dividend date.
Right. Yeah. Good point. But yeah, so they pay a 7% dividend. They pay a 7% interest rate to make it simple.
No, Halliburton pays, I think, is 9.2.
Okay. Yeah. I mean, all the dividend yields right now are huge because the stocks have dropped so much. So before the big drop, Regions was trading at around $16. At its low, it dropped down to $6. So it lost about 62%. Right now, it's recovered some. I think it's around $9. So it's had a pretty big bounce from that $6 range. But yeah, so that's my pick. My pick is Regions Bank. Stock symbol is RF. And those are two of the reasons why I picked it.
Again, remember, with my pick of Halliburton or Regions Bank, and I'll tell you right now, like Regions Bank isn't small, but it's not a micro bank, but it's a smaller bank compared to some of the big boys. There's going to be an influx of small business owners who are pissed about what happened with the economic support that was supposed to come to them from the government, all going to these really big organizations. And most small businesses didn't see a dime of it. And so there's been a huge push by a lot of the small businesses, which account for like 70% of the economy, that they're now looking for smaller banks to bank with that are small enough where they matter, but big enough where they can take a position. And Regions, I think, is going to fall right in that slot.
Yeah, because Regions is the 32nd largest bank in the U.S. So they usually rank the top 100. So it's in the top like third of banks in the U.S.
Yeah. So it's one of those where you can matter, but they can also take a position.
Right.
Literally, they can take a position. So just know what's happening, because this is one of those things where we talk about, it's not always, indicators in the market aren't always financial. like if you understand what's happening with the undercurrent of just businesses trying to survive in a Corona COVID-19 environment, then you can know behind the scenes many of these small business owners are getting together and figuring out what horse are they going to back in the race in regards to small banks or smaller banks, because they don't trust the big boys anymore. And it's going to be an exodus of money from some of these bigger banks. And so, just these are the things that we're going to be talking about. We do talk about, in the framework, because it's the side that you don't really always tie together to think about the potential of a Regis Bank.
Mm-hmm.
So, yeah. And with that,
just touch on the last point is that the money that was allocated for small businesses, it was about $360 billion. It ran out, right? Like it got depleted. I mean, on the first day that it was released, Bank of America got 6% applications on the money that they were on that money, on the $360 billion. So in the first day, 6% of that money was essentially gone. So if you extrapolate that out a few days, you see why it ran out relatively quickly. So these banks, they're really going to benefit long term because they, by definition, they have to lend and or grant this money to these small businesses. So there's a lot of influx, a lot of business that's going to come banks' way over the next 2, 3, 5 years, just because of this situation. But the flip side of that also is that interest rates are low; they're damn near zero. So banks' interest income is actually going to be down. So it's a bit of a a tug and pull. But long term, there's a reason Warren Buffett's biggest position he has are banks. They pay great dividends and they're too big to fail. So that's another reason why.
Yeah, and I think Berkshire Hathaway is down like 30%.
Yeah. I mean, everything's taking a massive hit. So I mean, this is great. Like I've always said, the greatest buying opportunity probably in our lifetime.
Yeah, and that's really why
something greater than Great Depression.
Yeah,
sorry, Great Recession.
So this is why we chose to do this. This is why we chose to make it now. The only difference, I think, is the fact that even when the recovery starts happening, this is still going to be extremely relevant. It's similar to how people are going to start taking their money or getting these loans from the banks. The reason why the banks want to be involved in distributing that money is because they have products. They have a suite of products that they want to offer as these businesses recover. And they want them to, since you did the loan with us, why don't you get a mortgage with us? And these lending vehicles are how they really make their money on the interest there. And if it's not the interest, because interest rates will be lower, it's the long-term capture of these bank customers.
Bank product, yeah. I mean, the banks are in the banks aren't doing this out of the goodness of their hearts, right? They're doing this because they want your money. Now, the situation we're in is very unique in that they're basically mandated by the federal government to make these loans and grants to businesses. But on the back end, it's great for them because they know, okay, once we do this, we're going to develop new relationships with all these new companies we didn't even know existed. The mom and pop pizza shop down the block is now banking with maybe say a Bank of America, a JP Morgan, a Regions, because they have to, because they need this money. So it's going to be an influx of possible new clients for banks long term, which is going to benefit them.
And then that's one for our pick today that's under $10. And again, we want to say thank you to Jamia because you took the time to write us. We dedicated this entire series to investments under $10. And what we're going to do is we're actually compiling a list of some of the stocks that are under $10, and we're trying to figure out where we're going to put it. So I don't know yet. But when we know where to land, for everybody who is in the Facebook group, a message will go out to you all. If anybody's watching this and wants to join our Facebook group, you can find us at Investing Education Academy. And this is what we're talking about. Like, if you have something on your mind or a question, let us know because we can dedicate the next series discussion to your question. So thank you for everybody watching. We'll be back on next Wednesday. Next Wednesday, we might be doing a 10 p.m. thing. We're not sure. So actually, if you guys could let us know, do you prefer 12 noon on a Wednesday or 10 p.m.? Send us a direct message. Put it in the Facebook group. Put it in the comments, wherever you like. We're trying to figure out what is best for you all. So with that said, Lee, got anything?
Nah, I'm good. Just know your risk. And every investment you know your risk before you get in. And only use risk capital.
All right, everybody. See you next time.
All right.